just an extension of the strategy that Nathan was just talking about. It's one you may have heard about before, maybe one that you've already got implemented. It does get a fair bit of press coverage. It's referred to as the transition to retirement strategy. Now this strategy is open to anyone who's over 55 years of age, even if they're still employed. And the simple way that it works is that you basically sacrifice as much as you can to superannuation via pre-tax salary sacrifice contributions, and then you replace that income with a tax-effective pension out of your superannuation fund. So look, in isolation, the salary sacrifice strategy, because the contributions are made from your pre-tax salary and a tax at a flat rate of 15% compared to marginal rates of up to 46.5%, that strategy in isolation already provides a fairly significant tax saving, one that is fairly common. But for many people who perhaps are spending all they earn, like what Joe was, they may not be able to utilise that strategy, and that obviously by sacrificing a significant portion of their salary, it does have an impact on their net take-home pay. So the advantage of this transition to retirement strategy is that they can replace that otherwise taxable income with either a tax-free pension if they're over 60, or a very tax-effective pension between the ages of 55 and 60. So moving on to Joe's situation, as Nathan mentioned, he's currently earning $100,000 and his take-home pay is just over $73,500. So what we've recommended to Joe is for him to sacrifice $25,000 per annum, which is the maximum that he's able to sacrifice to superannuation each year. And from 1 July this year, that's the maximum that anyone would be able to contribute to superannuation via pre-tax contributions or any employer contribution, regardless of their age. And what we've done here to replace that income that's been sacrificed, we started a pension from his superannuation fund, and that's the minimum pension that he's required to draw out of his fund, which is 4% of his account balance. So when we work out what tax has to be paid, we can see here that his taxable income is $75,000, so we don't include that pension because he's over 60 and therefore it's tax-free. So from an income tax perspective, he's saving around $9,000 in income tax. But even when we take into account the contributions tax on his salary sacrifice contributions of $3,750, his overall tax saving as a result of implementing this strategy is just over $5,600. And that's even taking into account that his net income has actually increased by $24,000. So not only have we saved him a lot in tax, we've also increased his net income. Now if he didn't need that income, obviously he doesn't want to draw that money out of superannuation, he could always recontribute that as a personal contribution. So when we combine this tax saving, the 5650, with the benefit of starting a pension that Nathan was just talking about, that saves him about $9,000, the combination of those two strategies provides an overall saving of $14,000. So obviously a fairly significant saving.